All right, everybody, welcome to the Q2 Do Your Retirement Group webinar. Thanks, everyone, for joining us. And if you're watching this after the fact, thank you for tuning in. Just wanted to get on here and talk a little bit about why you should invest in multifamily, why people are investing in multifamily or real estate, but multifamily specifically. Just giving you a little bit of different framework to think. We've gotten a lot of feedback and a lot of talked to a lot of investors, and this comes from a culmination of what we've gathered from our investors, and just wanted to deliver some different framework for investing. So let's jump into it. All right. So traditionally, we're taught that the market is safe. Your 401k, your IRA, bonds, stocks, right? Those are the safe assets to be investing in. And all those are great assets. There's a different way to think about them. And I think people, from talking to a lot of investors, they confuse liquidity and risk. They kind of equate the fact that you can't pull out your money of a real estate investment in a click of a button like you can with a stock or a bond. That there's more risk involved, and we're here to tell you that that's not necessarily. That's a common misconception, and we'll dive right into it. So, liquidity and risk. So those are two, I guess, budding factors. Real estate, the reason it's less risky, although it is not as liquid as other traditional investment classes, is because it's backed by a property. And there's a lot of ways you can make money within real estate. And there's a lot of ways that not only increasing value can do for your investment, but also tax advantages and things of that nature that we'll get into in a little bit. So the number one factor is liquidity, and the lack of liquidity does not necessarily mean an investment is more or less risky. Yes, it does take 30, 60 plus days to get your money out of a real estate investment, but real estate markets move a lot slower than stock markets, where you notice a huge crash within hours at times on the stock market or things like that. With real estate as an asset class, it does take 30, 60 plus days to get your money back. And in multifamily specifically, or syndication specifically, you're in it for the long haul. You're in it for 3, 5, 7, 10 plus years at times, and it depends on how the structure is set up. However, it's not as if you're putting your money in a lot of cases. And in the case of cash flow type real estate, you're not just putting your money in and hoping that in 10 years it's worth 3 times what your money is today. There's a lot of factors that go in. There's return that comes back as you go. So there are different advantages that come along with real estate as an asset, where other traditional asset classes you don't necessarily get. And to add to that, your 401k, if you don't want penalties, you are keeping that money in until 63 without penalty. Okay. So all in all, it is not the fact that if you can't get your money out in one day, it does not mean that the investment is more or less risky. So there's two major ways you can invest in real estate, and that's cash flow and appreciation. Appreciation is you either force appreciation or you are waiting for the market to appreciate, or you're speculating that the market is going to appreciate and your property is going to be worth more in the future. Where cash flow, you are ideally buying a property where you're making monthly profits when you buy your property, and then you continue to make more and more cash flow as the years go on with rent increases, with optimizing your operations, things of that nature. So those are the two major ways to invest. Now, that's important because cash flow is a much more controllable, we talk about risks, it's much more controllable to buy a property and cash flow and keep your expenses, your controllable expenses, where they're at. Now, there's a few things that can happen within an investment that are uncontrollable. However, you have insurances beyond that. So cash flow is super important because it essentially mitigates the overall risk of the investment. You're not gambling where you're buying a property and hoping it's worth more in the future. I call that gambling. Some people can do it and do it successfully, but wouldn't you rather buy a property, understand that you're going to cash flow X% and increase that year over year, with some minor discrepancies here and there, than hope and pray or force appreciation? We do force appreciation, increase rents. However, it's not a dollar for dollar game where we're saying this is going to happen every single time, where cash flow each month within a couple of percent of each other, you can get a good sense of what you're making month over month and year over year. And why this is important is because the market does fluctuate, as we're seeing over the last few years, especially in multifamily. The market has run up significantly and then it's run down significantly. And cash flow mitigates that risk, and it gives you the flexibility to where you're not forced to react. There's been a lot of syndicators and a lot of sponsors that have been in trouble lately because they didn't have controllable expenses. They didn't have controllable cash flow. They were banking on appreciation, and they were hurt over the last 5, 6, 7 years in commercial real estate and multifamily specifically. So that is why our strategy specifically is cash flow heavy, because of that factor. We're not hoping and praying that the market, when we go to sell, is at the high or at the low. We're making sure that we aren't forced to make any rash decisions. And the worst that can possibly happen is that we are cash flowing a significant amount when it's time to potentially go to sell. We aren't forced to sell because we can still cash flow and you're making your returns.
So I will go into the valuation piece behind the cash flow and the forced appreciation that Hayden was referring to. So when he was talking about buying a deal and buying it correctly, we are looking to buy a property that cash flows day one, right out of the gate. We can go in, we can increase rents to market and we can do that by renovating units, getting them up to speed, we'll say, to market rents, and forcing that value upon the property rather than in controlling that property's valuation as to stocks comparatively, that you're kind of at the mercy of how the market's flowing. So here's a real life example. We closed on this property not too long ago, and here's more or less our business plan behind it. In a very general sense, we bought this property for $3.3 million. And in order to increase our property's valuation, we need to increase our net operating income, our bottom line. So with rents, expenses, we are trying to increase that bottom line to force the appreciation. And the way we can control that is, as I mentioned, through renovating units and increasing rents up to market. We would essentially be creating $61,000 once we have gone through all of our renovations and pushed rents. We would be creating $61,000 in net operating income additionally. So by taking that $61,000 in additional in net operating income and putting it up against a cap rate of 6% roughly, you're creating an additional $1 million in value for that property. So by the time we're done stabilizing it and renovating it, our property would now be worth $4.3 million, an additional $1 million of appreciation that we can control. And why this is important, as Hayden was saying, it is in our control to force that appreciation and increase the value of the property, where stocks, you really have no say in how you can influence, unless you're Warren Buffett and can buy basically the entire company. There's no real way to influence the stock market in that regard, to force stocks to go up or down in that sense.
Yeah, that's why we really like real estate, and we really want that as our vehicle, and are using that as our vehicle to generate value and wealth for our investors. Now, who's controlling these properties and who's controlling the NOI and the operations of these properties? That's syndicators, that's sponsors, that would be us specifically. So all of this that we're telling you, all of these things that we can do to generate more value, to generate more wealth, to make your investment go smoothly, is controlled by us, and it's controlled by people like us, sponsors, and it is the difference between a good, bad, or great investment. Now, how do you operate, or how do you evaluate an operator such as ourselves? We actually have a guide, or a passive investor guide, that if you'd like, go into our website and go to our insights page, and you can download that, or you can reach out to us directly. But I'll go into a little bit about it, where we're talking about how you can vet an operator. The first thing you look at is track record. What have they done? That is where more or less of your risk is coming from, is your operator. What have they done in the past? Have they done a syndication before? And if they haven't, do they have direct knowledge or direct experience in investing in real estate? A lot of people have come into the business over the last decade who have little to no experience, and have been able to raise a lot of money, do deals, and some deals have gone well, some deals have not. So making sure that you understand the track record is imperative, and understand what your risk threshold for that track record is. If you're looking for people who have done a couple of deals, but maybe they give you a little more meat on the bone for a couple of deals, then that's your prerogative. And on the flip side, people have done a ton of deals and are going to give you pretty solid, not guaranteed, because there's nothing guaranteed, but solidly guaranteed returns for less of the pie. It's up to you on that specifically. Now, does your operator have skin in the game? If they don't have their own skin in the game, then how can you trust that they are going to do what's best for the project and for your money? Because their money is invested alongside. That's just a way to ensure that they're going to do everything they can to make sure that property is thriving and succeeding. There are structures to where not only are people operators are not putting skin in the game, they also are favoring their structure, or their fee structure, to where they make more money. Now, if you see those types of structures where they're making more money, they don't have any skin in the game, and it just seems egregious, that's a red flag. Going into fee structure, when do they get paid? That's a big one to look at. Kind of what I just mentioned, but when do they get paid? How do they get paid? Do they get paid when they buy a property and you get a massive fee to buy a property, and then you guys are splitting cash flow every month without splitting any sort of preferred return? So looking at how they get paid, and is it in line with the success of the property, or is it in line with, hey, we just bought this property, and if it makes money, we make money, right? Those are the things you got to take into consideration. And then the underwriting. If the guide also talks a little bit about underwriting. We're always here to answer questions if you're looking at a deal, and there are resources out there that can help you underwrite and help you understand what to look for when underwriting. But a couple big things are If you're looking at a property in Kalamazoo, Michigan, that they're saying they're going to buy today at $1 million and sell for $10 million in 2 years, and they're going to be adding some washers and dryers, well, that's probably not feasible. So making sure that what they're saying is feasible, making sure that there's data and analytics behind what they're saying, and there's recent history within that marketplace. Again, take a look. I strongly encourage you to take a look at our passive investor guide. It kind of teaches you how to understand that underwriting.
Back to the 401k versus real estate investment vehicles. Comparing the two, the 401k is a great safe investment. There's nothing wrong with these types of investments. And it's also a personal preference if that's something you would like to invest in versus real estate. But there are downsides to the 401k. In 401k stocks, in any regard, really, when you make money in your 401k, you are taxed on that money. Similar to real estate, when you make money, you are also taxed on that money, but there are ways to offset that gain through depreciation. So you're not taking a $10,000 gain and are taxed on that gain. There's ways to depreciate that and almost take a paper loss, if not a paper loss, and pay no money in taxes. And that money is now in your pocket rather than taxed. And these are just examples of ways that real estate investing differs from stocks or traditional, I'll call it, investments.
Yeah. And there's also, to piggyback off that, people might say, well, Roth IRAs, you can make tax-free returns. Well, the money that you're putting in to that is taxed dollars. So you're taxed. It's just at a different time frame. So there's taxes all around, and real estate gives you a great, to Matt's point, gives you a great way to offset that.
Absolutely. So taking all of these into account now, cash flow is going to be there consistently. If an operator is buying a property correctly, the cash flow will be there. And that is how we like to buy our properties. We like to go in, have cash flow day one. The controllable appreciation that we can go in, renovate units, push rents to market, optimize our expenses, and really grow that net operating income to force that appreciation, it's controlled in our hands for the most part. The tax treatment, as mentioned, there's depreciation to help offset some of your gains that you make through real estate. And just an overall different type of investment vehicle that can really shelter a lot of your income from being paid through taxes. So what can you guys do with this tonight? As Hayden mentioned, liquidity does not necessarily associate with risk and vice versa. Yes, real estate investments are typically illiquid for some time, but there are other ways that you can get your money back out of a real estate deal if there is a circumstance that you need your money out. Mm-hmm. The net operating income, knowing how that is going to grow within a business plan through an operator is very crucial to understanding the business plan and how they see the property operating over the next 3, 5, 7 years. And really evaluating the operator themselves and making sure that you're asking all of your questions, doing your due diligence on them personally, looking at their track record, making sure they have the knowledge and experience to do what they're saying they're going to do. And then, as Hayden mentioned one more time, the passive investor guide that we have put together is a great resource, not necessarily to only look at us with, but any investment that you are evaluating for future investments is a great tool to really utilize and help understand the ins and outs of all of these deals that are being presented to you, and making sure that you make the right decision for your own self.
Yeah, that's a great point, Matt. Just piggybacking off that, we want to help people grow their wealth. We want to be able to give people the the knowledge and the understanding that real estate is, while it can be scary, while there can be, a lot of dollars at risk, and it's not as controllable for you specifically, it can be a great wealth building, wealth generating, and tool for investors. There are tons of investors who make a lot of money doing it, and they do it the right way. And these are a few examples. If you go back and go through all 5 of the examples that we gave, these are 5 examples of how to do it the right way, of how to make sure that you're putting your dollars in the best position to put you in the best position when it's all said and done. So just hopefully you guys took some value from this talk today and from this presentation. And with that said, I want to open it up to some questions. So we had some questions come in the chat during the presentation, Matt. So I wanted to go through a couple of those, and if there's any more at the end, we'll open it up. So the first one. So Matt, you showed the $61,000 NOI increase that turned into $1 million value jump. What happens to the math if the cap rates move, or they change, or they're not what you're projecting when you go to sell?
The cap rate is really what values the property. So we base that on just over a 6% cap rate of taking that 61,000 and valuing it at $1 million, adding $1 million to that property, basically. So it went from 3.3 to 4.3 in a matter of 2 years through renovations and leasing everything up and stabilizing the property. Now, in our business plans, we give ourselves a 5 to 7 year or 4 to 6 year runway. We'll say that, hey, everything's going swimmingly, projections are being hit. We could sell this property year 4 and hit the same returns as projections in years 5 or 6. But on the downside of that, like you're saying, if these cap rates move and the valuation isn't quite where we want it to be, and this property is now trading closer to a 7 cap, meaning our valuation is a touch lower than we want. Well, we have years 5 and 6 that we can still, cash flow. There's still cash flow coming in through the property, but also look to sell in a future year. We're not strapped and trying to time the market on year 4 or year 5 specifically to say this is right when the valuation is going to hit and we can sell it at this exact dollar amount. So we give ourselves that runway along with the cash flow to mitigate that risks, the risk of any cap rate moving one way or another.
Yeah, and that's a great point, because like you said, our goal is clearly, it's outlined before we go into every deal, and we underwrite so that we can show you what we're planning to do with the property and when we're planning to give you your money back. You're counting on your dollars back plus your return within that time frame. So we are looking to get you that money back in that time frame that we tell you we're going to. And Matt's referring to, if there, that's why we give you that give ourselves that 2-year runway to make those returns. And if the world goes to hell, which who knows what's going to happen, if the world goes to hell in that 2-year time frame, well, the worst possible thing that can happen is we can keep the property and cash flow, because we have long-term fixed rate debt on the property. So our controllable expenses are controlled. Our operations are tight. We understand the property. We understand the property management company, and we are locked in from that standpoint. So we know that we are going to cash flow. So worst case possible, the world goes to hell. We go back to our investors and say, hey, look, we can't get the value that we want. We're going to cash flow 8, 9, 10, 11, 12% for the next couple of years until we can sell this thing and get you your money back. Or we refinance in that, and get some money back potentially. So that's kind of how we can mitigate that risk when it comes to. So next question came in. So you mentioned conservative renovation underwriting as a sign of a good operator. How do you actually know that your numbers are conservative and not just optimistic with extra steps. So I'll start with that, and I'll let you go into that, Matt, because you do a lot of the number crunching and underwriting. So how do we know that our numbers are conservative? We do a lot of deep market research. We do the research so that you don't have to. We've gone in for the last 2, 3, 4 years and understood the markets that we're in. We typically start years in advance. We're working on research in markets that we won't jump into already, that we won't jump into for another 2, 3 years, because we want to make sure we understand that market and we understand that how the market works throughout the cycles, the rental increases, where we think we can push, because we don't want to go into a market blind just because a deal looks great on paper, right? We do the research, the deep dive, so that, and we talk to a lot of people in the market consistently. Matt's on the phone and I'm on the phone every week with people in the markets that we are targeting and the markets that we're in, so that we can understand exactly what's happened in the market and where the market's at today and predict what's going on in the future. So I'll let you jump into that.
Yeah, and I think from a renovation standpoint, I'll start there. Talking with contractors, one, making sure you're getting multiple bids for every project you're doing. One, to vet a few different contractors, because not every contractor does exactly what they say. There's typically some hiccups here and there, but making sure you're not always looking for the cheapest price, but quality of work, a fair price, and timeliness. So you're trying to combine all those things in making sure that, okay, if we're going to be looking at a project that's 1,000 square feet, we need to redo flooring, appliances, countertops, and paint. Well, we're going to get bids from a bunch of different contractors to make sure our numbers are in line, and then give ourselves an extra reserve, we'll call it, to make sure that we're not over budget throughout the project. So that's from a renovation standpoint.
Mm-hmm.
From an underwriting standpoint, like Hayden was saying, we know we've done a lot of research as far as expenses go and what those expenses look like within that market. We've gone to the length of talking with property managers and almost getting case studies back from them saying, like, we're looking at a property of X, Y, and Z. Do you have anything that fits that mold? Can we look at how that property is operating?
Mm-hmm.
And that gives you a real life example of whether it's a hands-on operator that is using a third-party property management, or someone who's hands-off. And it kind of gives you both sides of the deal where, okay, this one you can clearly tell that the operator is a lot more hands-on with the property manager and going through it daily, weekly, to make sure that the expenses are optimized and efficient in that sense. So conservative underwriting, a lot of people say they're conservative in what they're looking at, but really making sure you have a depth of knowledge and examples behind what you're presenting or your business plan goes a long way when you're actually underwriting a deal.
Yeah. And I'll close with this on that subject is the day that we close on a property, our underwriting goes out the window. You know, we close on a property and everything from there on is no longer speculation. It is true and accurate. And so all we can do is take that information that we're getting, use the information that we've received, input that into the property, optimize the operations as much as we can, and continue to press and hit our marks or beat the marks that we've set for ourselves. So we take a look at it constantly on a monthly basis, and are consistently on the pulse of our current properties and future properties.
Absolutely.
There's one more question, Matt, that came in, and I'll take it. These are great questions. I appreciate them all. And that is, if I'm not ready to invest right now, but want to stay close to what you're doing, what should I do today? And that's a great question. So what you can do today, if you don't necessarily have the $25,000, $50,000, $100,000 to invest today, is continue to educate yourself. attend webinars like this, whether it's ours or some other sponsors that's educating you on real live data that they're seeing in the market, and that they're seeing in their day-to-day jobs, because this is what we do. This is what we live and breathe, just like you live and breathe your profession. This is what we do. And so continue to educate yourself. There are tons of resources out there. Reach out to us. Take a look at the resources that we provide, other sponsors provide, and just be ready, and continue to stay on top of the deal updates. You can be a part of several different sponsors' email lists, and get on those email lists if you like, and make sure that you're looking at the offerings that they're providing, and underwriting those deals, looking at those deals. What am I looking at? Researching what they're saying, how they're saying it. Research. If you don't understand something, research it. We also have a glossary of terms in our guide, in our sponsor guide, or passive investor guide. We have a glossary of terms that you can take a look at. So if you hear, NOI, you hear cap rate, you hear these terms that are confusing, go look at that. Look it up on Google, whatever it might be, and stay informed. And so when you're ready to go, reach out. You got to reach out and talk to us, and we'll let you know when our next opportunity is, which real time right now, we're in end of Q2 of 2026. We should be getting into contract here very shortly. So stay updated. We send out emails consistently, and be ready for it. So
Very well said.
perfect. Well, again, appreciate everybody for jumping in here. I know it's a Tuesday night. You got things to do. So what more could you want to do than learn the risks of real estate? But no, we really appreciate you jumping in here, and we will see you next quarter. September will be our next quarter's webinar. Look for it. Stay tuned. We'll keep you guys apprised probably towards our August, or in our August newsletter. You guys will see what day that is. Make sure you carve out some time, and we'll continue to educate. If there's anything that you guys want to learn or questions you have, let us know, and maybe we'll do a presentation on it. So thanks so much, guys.
Awesome. Thank you.